Hello and welcome to a brand new show of Market Makers, and this time we are coming to you from Singapore. Our guest on the show today is Dipesh Pandey of IIFL. Dipesh, good to have you back on ET Now. Thank you for joining us. First, characterize the market environment for us. Looks like we're getting twisted from all the sides. Globally, it is macro. Locally, it is micro. The situation net is very scary.
Yeah, it's clearly a situation of panic. You can see that from the way stock prices have behaved over the last 2-3 months. You can see that from the level of activity, trading volumes, outstanding interest in terms of derivatives, etc. So clearly there is a very high degree of pessimism. A lot of it is justified looking at the local and global factors, and therefore it's quite logical that investors will behave the way they have. So net, I would think that looking at stock prices, looking at investor sentiment, it's a very seriously pessimistic situation right now.
So things, to your mind, will get bad from worse before it will get better?
Looking at the way prices have corrected, we are much closer to a bottom right now than, therefore I see a limited downside from these levels.
So 4 factors which are plaguing markets down. A, it's Europe. B, it's currency. C, it's inflation. And fourth one would say is fiscal deficit. Do you expect out of these 4 factors, at least 2 domestic factors in next 1 year will improve?
Yes, I think if the way commodity prices have corrected off late, that gives a lot of hope on both current account deficit and fiscal deficit. So crude oil prices where inventories are running very high, if they stay at these levels, that means a big positive for India's fiscal deficit as well as current account deficit. I think seeing the pressure from all over, including rating agencies, there should be some action from government front in terms of reducing expenditure, and combine that with some correction in commodity prices should result in improving inflation outlook, improving fiscal deficit, improving currency outlook. So these are some of the supportive factors, but again, global situation is still variable, volatile right now, and that could impact markets in the very short term.
But domestically, you think all the bad news is in the price?
Looking at the stock prices, yes, but again, if situation continues like this, if there's no, measure to improve growth profile of the economy, to reduce subsidy, we may continue to grow at low pace, maybe 5 to 6% range. Therefore, stocks, may not go anywhere. So we need some sort of triggers, some sort of action by government, some improvement in global scenario, and those things, should help in terms of improving market levels.
Are you working with the possibility that we could go back to December lows?
We are hardly 5 to 6% away from December lows in any case. So if there is a negative shock from Europe, it might as well happen. But again, I would think that bounce back will be equally strong, because even at these levels, valuations, if you start looking at bottom up level, look very good. Therefore, I would think that possibly yes, it could touch those levels for a short while, but I think bounce back will also be equally strong.
So for this year, this calendar year, the Nifty range has been about 4,700 to 5,200. Do you think this 4,800 to 5,200 Nifty range will exist for next 6 months?
Yes, I think there is strong support at the lower levels, and upside possibly, the upside range could be higher depending on if there is a commodity prices remain suppressed, especially crude oil prices, because historically what we have seen is that crude oil prices have bounced back, in any risk on trade which happens. So if crude oil prices, correct to these levels, I think the upside level could be higher this time.
Insiders are telling me that you're fully invested and you are getting your portfolios towards risk rather than the protection side.
Again, it depends on how you define risk versus protection. What you traditionally think as defensive or sectors with low beta, those look very expensive in terms of valuations, and you would think about names like consumer staples in particular. Again, I think if the hypothesis is that economy will remain in a slow growth mode, even these sectors will start seeing some slowdown, and that's the time when investors will start exiting these sectors and stocks, because in any case they trade at very high valuations. So I think the margin of safety is low in these sectors right now. Therefore, it makes sense to start switching to a more economically sensitive sectors and stocks.
But we've heard this argument last year as well. But the bottom line here has been that those who bought defensive stocks, they are outperforming, and those who bought infra or banking stocks, they are underperforming.
Yeah. So I guess again, we have seen this trade now playing out for almost 24 months. But my own hope is that, we have already seen some bit of rate cut, and that rate cut cycle has started. It's getting supported by lower inflation and, progressively lower growth rates. I think as this trend plays out, there is now, that trigger for rate sensitives to start performing again, especially also looking at the valuations, which prevail in that, in those segments. So I would think that now you have the supporting conditions, for this trade to play out.
So within the consumer space, where do you think there is a boom and there is a bust?
So I think there is no boom and bust situation per se, but there could be a time decay in these stock prices, because stocks have done well, companies are doing quite well. So stocks may remain flattish, they may not participate in a rally, which may happen. But obviously, vice versa, they will not also fall, because companies are doing fundamentally quite well. So if you are hoping, for a bullish market, if you see some strength in the market, these stocks may remain flat or may underperform. But operationally, these companies, all of them are doing extremely well. There could be some slowdown in terms of top line, but I think otherwise these companies are doing extremely well.
Your current tactical trade is revisit banks, and within banks you're bullish on PSU banks. Why are you bullish on PSU banks?
PSU bank trade is a very selective trade. I'll be very careful in terms of picking banks over there. First preference is always for private sector banks. Within PSU banks, there are banks which trade at half times price to book, banks which are offering you 5 to 6% dividend yield. And some of these banks also have managed, credit quality quite well historically. So as a general segment, I'll be very careful. I'll pick up maybe 2 or 3 names because, across the sector, you've seen very high range of delinquencies and stress in the books. So there are a few names, which look good, which have good record in terms of credit quality, asset quality. Those are the names which I would focus on.
At these levels, is one better off buying a HDFC Bank, which is growing but is expensive? It is at 4.5 times price to book based on FY13 estimates. Or one is better off buying State Bank of India, where earnings will be volatile, but valuations again mouth-watering, less than 2 times based on FY13 estimates.
Again, it's a function of your time horizon. HDFC Bank is an absolutely great bank in terms of its track record, execution strategy. So if you ask me this question on a 3 to 5 year horizon, I'll bet on HDFC Bank. But on a shorter term horizon, I would think that State Bank of India or some of the PSU banks can do better over the next 6 to 12 months. So it's all about time horizon, what time horizon you're looking at.
So what is your short-term market outlook, medium-term market outlook, and long-term market outlook?
So in the short term, as I said, a lot depends on what happens in Europe. That's very crucial. You have very high degree of uncertainty over there. Even though valuations in India look good, but European situation will determine what happens to the market. Over the next 12 months, I would think that, if you're talking about 15% kind of earnings growth, possibly you will have some re-rating from the levels which we are at currently. So I would think overall about 20% kind of returns should be expected. But this will again hide, this I'm talking about in terms of index returns, but there will be a lot of stocks which will do far better because stock prices movement, especially in rate sensitive segments, should be much higher. So I think it's a market which is all about stock picking bottom up. You could have some outstanding opportunities. At an index level, I think 15 to 20% is what is achievable over 12 to 18 months.
But given the way how currency has moved this year, the fact that Indian markets in last 4 years have done nothing, are your investors now asking you tough questions?
Yes, of course. Investors have been quite unhappy about India market, and at least in terms of dollar returns, markets have been flat for now almost 5 years. So there is, a lot of pessimism. There is a lot of, impatience about the way Indian markets have performed. So I think you need some bit of rally, both in currency as well as in the markets, to bring back some interest of investors. And I guess investor interest should catch on if both trends continue. But right now it's obviously very, very difficult to sell any India product looking at the past and the near-term outlook.
So what's been the strategy at the broader fund level? Are you getting inflows, outflows, redemptions?
We have seen some inflows in the earlier part of this year and late last year, and that was the time when we were aggressively pushing stocks from a bottom-up perspective, because macro story has been difficult to sell for India over the last 12 months. Of late, I guess there hasn't been any kind of reaction, but investors are obviously quite unhappy about the last 2 months because currency has fallen a lot, markets are down. So I think we really need some positive triggers now for markets to sustain, to move up, currency to bounce back, and hopefully then we should see some inflows.
If Indian markets correct another 10% from these levels in dollar terms, do you think you will get inflows or outflows?
If markets correct, 10%, I don't think they will do anything, because if they had to do something, they would have done it last month. But yes, I think it will obviously make it very painful for investors because they've already seen a very substantial loss this year in terms of currency adjusted returns. I doubt they will react immediately in terms of, further redemptions.
Dipesh, historically, this kind of a price action always leads to a new crop of opportunity. So where do you mind the new crop of opportunity is now surfacing up?
In India, I think, as I said, at a bottom-up level, there are very interesting opportunities. And again, starting with financials, you have some of the government-owned banks, you have some of the non-banking finance companies. Private sector banks have done well, but I think they are long-term performers, so that is one segment which one would hold on. I would also start looking at some of these cyclical plays. Media is one segment, possibly electronic media companies or print media companies. I would also look at some of the engineering names. We have Larsen & Toubro, which has guided extremely well on revenues and order book this year, and possibly some of that should percolate down to one or two other companies in that segment. So that's a segment where you are slightly early in terms of making your call, but valuations are very supportive. So these are some of the broad segments. I guess in the mid and small size space there are a lot of opportunities looking at valuations. So these are a few of the segments which I would look at in terms of opportunities.
So from the large cap space and from the mid cap space, at a fund level, at a portfolio level, where are you allocating disproportionate amount of money where you feel the downside could be 10 to 15%, but the upside in the next 2 to 3 years is at least 50%?
So as I said earlier, financials remains a big segment, and private sector banks is a large part of that. And
so if you nail it down to names, what do you like?
So I would think names like ICICI Bank, Axis Bank, Yes Bank amongst private sector banks. In government-owned banks, SBI, Bank of Baroda, Indian Bank, these are some of the names. In NBFC space, I think Bajaj Finance, Indiabulls Finance, these are some of the names which look very good. Again, as I talked about, some of the mid-cap companies, so, you could look at some of the fertilizer companies, you could look at some of the print media companies, which, have had a tough time last year and therefore stocks haven't done so well. So these are some of the names which I would look at in terms of picking up stocks for next year.
So let's pick up some of your top holdings, ICICI Bank and Yes Bank. What makes you bullish on ICICI Bank? Valuations, management, or the fact that the stock has been a marked underperformer and they're getting a lot of money now from the corporate sector and corporate sector is about to revive?
ICICI Bank, has executed its strategy very well over the last 3-4 years under the new leadership. So they have improved their CASA profile significantly. Credit losses have come down. Asset quality experience has been very good last 12 months in terms of restructuring and asset quality wise. I think they're delivering good growth. They have a good mix of retail and corporate, and valuations are very reasonable. As you said, stock has underperformed over last 12 months. They're guiding for reasonable growth, 15%, not as high as it used to be. So look, combining all these factors, I think valuations are much below the longer term averages, which is what makes it interesting. Yes Bank, I think, has had a phenomenal track record. Being a small bank, they've grown very well. They have their stated ambition of, growing 30% for next few years. Again, private sector banks stand out in terms of asset quality, and Yes Bank also has done extremely well on asset quality. So I think as a bank, it looks very good on valuations, asset quality trends, and they're also executing well on CASA front. So that's why, Yes Bank as a name.
Are you also revisiting commodity consumers, airlines, autos, given the way our commodity prices have collapsed? These companies or these businesses in the near term could report margin expansion?
Automobile companies have a top line issue right now. There is slowdown. Clearly, we need to get over with this slowdown. It may continue, and there could be monthly, disappointment. You have monthly numbers. So auto sector is easy to track. I would, possibly look at two-wheelers. Nothing beyond that. Commodities as a sector, I think, again remains hostage to what happens in Europe and in China, and in that sector you have companies which have problems in terms of ore availability and coal availability. So again, a large part of that sector is also not worth looking at this time. Yes, but automobile should benefit from the commodity price movement, and that should help margins. But I think the top line is an issue in automobile companies.
The street is divided on how should portfolio managers approach commodity stocks. The bulls are of the view that commodity stocks, at least the large ones, whether it is Tata Steel or Sterlite Industries, they are available below their replacement cost. The bears are of the view that commodity demand will slow down further because of China, and in the near term, one should avoid commodity stocks. What is your house view?
The top-down view is clearly bearish. If you're talking about slowdown across the world, including China, and China being one of the biggest consumer of commodities, you're talking about further slowdown in Europe. U.S. growth signals have been mixed. So the top-down view is really positive. But again, in such a scenario, you get few companies, at very good prices. So Tata Steel is possibly one of them. Stock has done quite badly, and they have a huge, captive iron ore and coal base.
It's gone below book value also.
Yeah. So while chorus is a problem, but India business will have strong volume growth. So Tata Steel is one interesting name. So you could find one or two stocks, but I think as a segment, there are a lot of problems, company specific issues, and therefore I will kind of stay away from this sector.
Is it too early to revisit and pick and choose from the wreck of infra?
I think most of the companies in that segment, need balance sheet repair, which could be a time-consuming process. There are obviously issues, policy issues. A lot of these companies have gone overseas and acquired assets where, as an investor, we have very difficult, it's very difficult to formulate any opinion on long-term, profitability. I think it's best to stay away from most of these names because, balance sheets will be under a lot of stress, and so we need to monitor them over the next 6 to 12 months.